Mark Sebastian of Option Pit Mentoring joins us now for Investing 101. And once again, the market is taking investors on a wild ride. So I know some people might be feeling fear. Maybe they're feeling like this is the time to make some changes. I want to talk with you about hedging. You say that's playing out well for you.
Yeah, well, hedging is key. So one of the things I pay attention to is instead of trying to always be hedged, which is really, really, really costly, when the market is telling me it's time to hedge, I like to hedge. So right now, the VIX is really high and trading at a premium to VIX futures. Little into the weeds, but just the cash VIX, the VIX index that gets quoted on all the networks like this one, and the VIX future, which is a little more into the weeds, it's trading at a premium to that future. When that happens, that is the market telling me that there's going to be turbulence. That is the number one sign that things are going to be much higher volatility than normal. And so when I see that happen, that is when I'll step in and set up a hedge. So it's interesting. I don't mind paying up for a hedge when they're needed, because paying up for a hedge when they're needed is actually cheaper than constantly buying hedges when there's nothing going on.
Okay, so let's take a look at what you do here. Just break this down.
All right, so I'm long the market.
So he's got his portfolio, his basket of stocks.
I have my basket of stocks, or in this case, synthetic option trades.
Okay.
And then I take a portion of that notional value.
Okay.
And as the market heats up, I will hedge more and more of it with put options, long VXX or VIX calls, to build a portfolio of long volatility that is counteracting my beta to the S&P 500, my beta to the overall market. So what happens is, as the market drops, my hedge starts to really work. That's how they should work.
Okay. So for someone who's like, wow, that's just too much, too complicated, but I have all these shares of IBM and Google and Apple, and I don't want to lose too much money if the market goes down. What do you do in that case?
A simple trade would be go into the S&P 500 or SPY and buy a 2,500 put, relatively, with a month or two out, and it will not be super cheap, but it'll be a line in the sand so that the portfolio doesn't lose a lot. I mean, the market, yeah, it's down in the year, but over the last couple of years, it's up a lot. Getting out at 2,500 is still a massive win for most investors.
And people can sleep at night for those who want to take advantage of that opportunity. For others who just want to ride out the storm, that's another option.
Exactly.
Thanks for coming on the show today.
Thank you for having me.
Check out businessfirstam.com to find out where to see our entire show. And don't forget to like, follow, and share Business First AM.